Hello, my name is Russell Myers. Welcome to Issues Unite. I realize in my videos I'm always wearing a fairly similar shirt. It's not that I don't change clothes, it's that I've got a lot of shirts with Henley colors because that's just my uh, favored style. Uh, you will notice they at least change colors from day to day. Uh, so, um, Now, I'm sorry to keep on coming back to the same subject on oil. Um, you know, if you watched enough of this channel or read enough of my writing, you know I go from one subject to another and don't stay stuck on one thing. But the fact is that the oil issue right at this moment, um, and for quite some time, has actually been a lot more important than most people give it credit for. I mean, it's the basis of all of our wars in the Middle East, our threats against Venezuela, our threats, a lot of our threats against Russia. So, the entire value of the dollar is based on oil. So when there is a problem with the oil trading system, that is a problem with the dollar. So, so I wanted to go into how oil futures work, or how futures in general work. If you saw Dylan Radigan on the Jimmy Dore show, he did a fairly good job explaining how the futures market works. However, I do think he was still sounding like someone who's been doing this for most of his life and may have left some things not entirely clear. To me, it kind of sounded like, let's say, a refresher course for people that have encountered a description of this before. So I'm going to try and explain it in simpler layman's terms. So let me jump right into it. All right. So let's say I am an oil futures trader. Oil is sold in futures, meaning that what a trader buys is the right to take delivery of oil on a certain date range. All right. Most common is about a month in advance, but it can be much further. It can be 2 months, 6 months, a year and a half, whatever. So this is done when a trader and an oil producer agree to a futures contract. And by the way, the reason for the 1 month thing is because, they want a short-term profit. They don't think out 5 years. And they're not willing to sink their money in 5 years in advance. All right. So when the futures contract is signed, as a trader, I pay for the contract immediately. For example, I agree to buy 1 million barrels of oil at the current market price. For example, let's say $20 a barrel. That means I pay the producer $20 million right now, or I am obligated to pay the producer the contract amount even if I do not take delivery. Okay? That's a key point. All right? So the oil now belongs to me. That 1 million barrels belongs to me. And the producer is obligated to deliver the oil during the date range that is specified in the contract, such as the first week of June this year. Now, chances are good to buy the oil I took out a loan. Now I have to find someone to buy that oil from me and take delivery in the same time frame. So the problem is, right now, demand is low and nobody wants to buy it. Global oil storage is nearly at capacity and nobody has room to store more. So, in any case, what I am doing is gambling on the price of oil rising before I sell the oil. So, I buy it at $20 a barrel. If oil prices increase to $30 a barrel, I make $10 million on the transaction minus delivery cost. Now, this is simplified and delivery is discussed later on. All right. Now, however, because of the supply excess, the price of oil has dropped since I signed the contract. I don't have storage, and nobody will buy it at the price that I paid. That means I have to sell the oil at a discount, and I lose money. So I'll have to sell it at a lower price and take the loss, or I default on the loan. So storage is not the only problem, so is delivery. Okay? Oil sales can be limited at any time depending on availability of transport. And usually very large crude carriers, VLCCs. So these VLCCs have contracts as well in advance. So to compound that problem, some traders have contracted VLCCs to park offshore. They buy oil, load the VLCC, park the VLCC offshore. You know, they bought the oil at what they thought was about as low as it was going to go. They park it. They wait until until oil comes up in price. The oil has not been coming up in price. Now, each day that ship is parked costs the trader as much as $200,000 per day to lease that VLCC. So if I sign a futures contract, find a buyer, the entire thing can fall apart if I cannot arrange delivery, which means I would have to pay out the entire contract, but then lose a claim to the oil if that date range passes without me taking delivery. So if I can manage to take delivery and I don't have a buyer, then I have to pay for storage until I find a buyer at any price. All right, so this is largely what happened in the past week. Oh, last point on that, on some contracts, the buyer agrees to pay for delivery. In some contracts, the seller, me, the trader, agrees to pay for delivery. So that is all included in the contract. All depends on how the contract is written up. All right, so what happened this past week is that traders had contracted or even taken delivery of oil, but they did not have any buyers. So the price of oil was already low and declining. So the traders had to go to extremes of paying buyers to accept delivery so that they could avoid defaulting on loans or continued cost of storage, often on those VLCCs that were already full, but they had no destination. So they had to find a buyer to give that ship a destination to offload so that they wouldn't be paying $200,000 a day. So even paying buyers to accept delivery will have an ongoing depressive effect on the price of oil going forward. It simply means that buyers have oil stored near or at capacity. So they will not need to buy any oil at all for some period of time. And this is happening at the same time that production is above demand and storage rates globally are racing toward capacity. So this is how commodities futures in general typically work. Doesn't matter what it is. It can be corn, wheat, soybeans, what have you. The difference is that oil cannot be simply disposed of for the sake of increasing the market price. And other markets, agriculture, those markets, the commodities can be disposed of to maintain or force higher prices to buyers, including consumers. They don't have to keep storing it. And that happens very frequently. So some sources are claiming that this historic event with oil going below negative was a one-time fluke. Now, I'm not convinced. I find it highly likely that traders may still be saturated with existing supply in combination with maturing futures contracts that they signed previously. So it's highly likely that we're going to see the same thing around the middle of May. So, the middle to the last week of May, we will probably see the same thing happening with oil going negative. Maybe to a lesser degree, but it may happen anyway if traders are unable to renegotiate contracts, though they probably tried that this month.